we're going to walk through the chapter 4, problem 57. This is a comprehensive consolidation, so it has a little bit of everything in it using the equity method. And so go ahead and pause the video and read through this whole problem. There's a lot of information here, so definitely just go ahead and read through that, and then we'll jump in together and try to make sense of it all. All right, so starting out, the very first thing that we are going to do is just kind of set up the AAP so that disaggregate it is really. So we're going to document all of our AAP. And so we'll start with our accounts receivable. And we're going to come cell reference this up here. And we'll grab building. Our customer list. The notes payable. And also the goodwill. All right, and then we'll just do a sum over here. Oops, too far. All right, and then we're just going to show each year's amortization. So for this AR, it indicates that it was just collected the next year. And so there's not, we don't really need to like drag this on forever. So that one's just going to be the one single one. For the building and equipment, if we come back up, it should give us years. Yeah, down here, 6, 7, and 4 years. So we'll take this. I'm going to lock this in so that we can divide it by the years, and then also lock that in and drag this down so that we see it over and over again. Now I'm going to put a negative sign in front of it. And no, I'll just leave it alone. And so I'll fill that down because that's going to be the amount for every year. And then we really just need to do the same process. So we'll go divide this one by the 7 years presented here. Same thing again for our notes payable. Okay. So we really just plugged in a whole bunch of information here. There's no amortization on the goodwill, so we can just leave that blank. We can pull our sum function down if we'd like to so that we see the amount of amortization for each year. And then we're going to calculate the balance as of the beginning of the year. And so I'm going to actually say minus the sum so that hopefully we can pull this over. And so again, this is just a preference. If you would prefer to list these as negatives and then just sum them down, you can. But either way, what we're trying to get to is that we see that we have a balance at the beginning of the year of 0 for the AR, building and equipment, customer list, notes payable, goodwill, and a total. It's also important to see that notes payable has now zeroed out. So there's not going to be any amortization for this year, 2022. Same thing, the AR has already been zeroed out. So that's also going to be at 0 for the year 2022. This, we can kind of just actually go grab these from above if we'd like to and pull that right. A notes payable needs to be 0 because we can't take it down any further. And then we'll take our balance minus the amortization and pull that to the right. And I guess we could have pulled this down. But I do not like that sum. Oops, actually, never mind. Should have looked at this formula before I pulled it down. Let's undo that. So we'll do a sum across the row. And again, we'll just do another sum across the row. And so now we kind of have it pulled out the balance for all of this information at beginning of year, also the balance of all of these AAP items at the end of year, and the amortization that took place in this particular year that we're working with now. Then we're going to come down and calculate the intercompany profit and losses that have happened. And so first we'll just start with the deferred inventory profit. And so downstream, we'll come back up here and we'll grab it. So we're looking at for the year 2021. And so there's, let's see here. Oh, okay. This 25% profit margin is what I was missing from the data. So we have a 25% profit margin, so we can grab this remaining and the ending of our sub and multiply it by 0.25. And so we get 3,780 there. Then on the upstream portion, we'll come up and grab the year 2022. And then we need to grab this gross profit remaining in our ending inventory for the parent, multiply it by the 0.25. And so we get 2,520. And then we also have the unpaid intercompany amounts. So we'll go get those of 3,600 and 5,040. Then we also need to grab the intercompany sales for the current year. So we'll go grab these intercompany sales. And for whatever reason, I worked backwards. So I flip-flopped the location of the years. This is 2022 though. So we'll come up here and get our intercompany sales. Deferred asset profit that we have. And so we just need to kind of set this up so that we can better see that. So let's first go grab our sale price so that we can get down to what the profit actually is. And if we scroll back up, we're going to find that up here. So for 81,900, the carrying value was right below that, the 6,300. And if we divide those, subtract, we get a profit of 18,900. So as far as the deferred downstream gain goes, we're going to pull that 18,900, and then what we need to figure out is the annual recognition. And so I'm going to just move over to 1231 because it wouldn't have been recognized right here. So in 1231.21, we will take the difference in the profit. So we'll grab this 18,900 and I'm going to lock that in, and we'll divide it by the remaining life that was given, 6 years. And we get 3,150. And so now we can just say the original downstream gain minus that difference. And then we can really just pull this all the way to the right. Oh, I must not have done something in my formulas. Oh, I didn't lock in D29. Okay, so now we just have this information here that is updating the annual recognition and the deferred downstream gain balance for each year. So that'll be helpful when we actually get into the CD process. Part C is asking us to look at the pre-consolidation equity investment beginning and ending balances. And so we'll start up here looking at the investment as of the 1st of 2022. And so if we go grab the stockholders' equity at the beginning of year, I made a note to you that you'll have to get the common stock and retained earnings to figure that out. So we'll come up, that was too far. We have common stock here plus beginning of year retained earnings. So we have 302,400. Then we're going to add our AAP. Which we have right here. And we have this, like we can see this is the beginning of your total. So we'll grab that. Then we're going to subtract out 100% of the end of year deferred deferred end of year downstream intercompany profit. And so we already kind of pulled all this information down. So we'll grab this downstream 3,780. And then we're also going to subtract out the downstream asset gain. And so we'll grab this 15,750. And then we'll sum this up. And so we get 329,310. And then for the ending, we'll go grab the stockholders at end of year. And then we'll add our AAP. And so now we have end of year right here. So we'll take the 35,100. Then we'll subtract out our deferred profit on the intercompany sale right here. So this is now looking upstream. And then also subtract out the gain. And so this is end of year 2022. And we'll sum this up. And there we have the 334,980. And part D asks us to also actually just reconstruct the T account of the equity investment. And so we can do that. We have this beginning balance right here. We will go get the net income from our subsidiary. That was too far. 30,240. Then the deferred profit that's been confirmed right here, 3,150. Then our beginning of year inventory profit that's been confirmed, which is the 3,780. Then our dividends. And I'll put a negative sign so that we can convert this to a positive. We're going to go get the AAP amortization for the year. And so it's this 11,000 is the total that we amortized for the year. Or actually, let me double check. I just realized there's a difference because this one stopped. We stopped amortizing the notes payable. So we need to make sure that we're getting this year 2022, which is 11,340. And then we also have the end of year inventory profit deferred, which we already found up here, 2,520. And then if we do a sum here of our debit column minus a sum of our credit column, we get that 334,980, which aligns with what we identified right here. And let's go see if that matches our balance sheet. So double check that number, 334,980. And why are my eyes not finding it? Okay, we just We just named it investment in subsidiary instead of equity investment. But there it is, $334,980. So that's all good. Now that we've just kind of done all of that stuff, we'll jump into our actual CD entries. So we'll start out with the C, where we're going to eliminate the income from our subsidiary. We're going to eliminate dividends, and we're going to put this in our equity investment. And I'm actually now curious down here. All right, this time all around, it's just called investment in subsidiary. So be aware of that. But let's grab these numbers. $23,310. Dividends of the $17,640. And so we have $5,670 on the equity investment. Then we'll eliminate the stockholders' equity. And in this case, there was only common stock and retained earnings. So we'll go get those from our balance sheet. Common stock. Remember that the retained earnings is the beginning balance, so we need to come up to our retained earnings. And we'll sum these together. Then we can begin the AAP. And so we had buildings and equipment. We also, let's come double check this. So we have the AAR is already gone. The buildings and equipment I just wrote. We have customer list. We no longer have this notes payable, and then we have goodwill. So we need customer list and goodwill. And that'll go to our equity investment. And so we'll come back up here, and we are going to grab this blue balance that was our beginning of year balance. So we'll take the $7,560 for the building, $20,680 for our customer list, and $16,200 for goodwill. We'll sum those up. Oh. Okay. Now we'll actually do our depreciation for these. And we'll just grab our buildings and equipment customer list from above. Then we'll come back up to our little table and get the annual depreciation for each of those. Then add those together. All right, now we'll begin this process of doing all of our I entries. So I'm telling you, these first three, I gave you space to take care of the intercompany sales and the adjustment of the inventory from last year or current year. Take care of all three of those. Then eliminate the intercompany receivable and payable, and then deal with the gain on the building and the depreciation adjustment that needs to happen below that. So we've done all of these before, just now we're doing a couple or like two sets of them inside of one single problem. So let's start out, and we'll do our equity investment and our COGS. And we'll come back up. And so we'll grab our 3,780. This is our prior year. Then we'll take care of the current intercompany sales. So we'll do our sales, COGS, and come back up. And this is going to be, got to double check since I flopped our years, the 2022, so 18,900. And then finally, we'll do this current year amount. So we'll do COGS, inventory, and go grab that 2,520. And then the last piece of eliminating this intercompany sales is to eliminate the accounts payable and the accounts receivable. Intercompany, of course. And we'll come back up. And looks like oh, right here. Okay. So the year 2022, and then we have it right here, unpaid intercompany amount of 5,040. So we'll steal that number. And then finally, this process of eliminating the deferred gain and then also the depreciation adjustment. And so we will first do our equity investment. And that's because the gain on sale was closed equity investment the year of the sale, or closed, I'm sorry, to retained earnings for a subsidiary, which then means we need to update our equity investment. And then we'll do our buildings and equipment. And so we're going to come up and grab this 15,750. And so that is as of beginning of year. And so that's why we're grabbing that one. And then we're going to also take care of this recognition of 3150 in the next transaction. Okay, so then the last piece of this is that buildings and equipment and our depreciation expense for 3,150. And now we have all of those entries completed, all of the journal entries. So now it's time to go ahead and post them into the worksheet. So I'm going to pause the video and do that, and then I'll share my screen so we can all make sure we have the same numbers. Okay, so now I have all of my consolidation entries posted, and you can go ahead and I'll zoom out. So if you want to see them all at once, you can pause the video and just confirm that you have all the right things in the right places. And then we can also do our confirmation of things like net income is equal to the parent, come down and check our common stock. And so that's equal to the parent. So that makes sense. And also just confirm that our investment or subsidiary or equity investment is zeroed out. And let's also check up here. The income from the subsidiary is also zeroed out. So all of those are good checks and we're good to go.